Hello, everyone. We're just waiting for people to join. So get comfortable, grab yourself a cup of tea or a drink of water if you are, and we're going to give it a minute or two and then introduce ourselves and explain what we're going to cover today. Good. Well, I'm sure more will keep joining as we come in, but in the interests of sticking to time today, let's kick off. Welcome. My name is Andrew Hedges. I'm a partner in the climate change practice at Baker McKenzie, based in London. And it's a real pleasure to be with you today, talking about such an interesting topic, one that is both theoretical in a way, but is something that myself, Ruth, and the wider global team at Baker McKenzie are grappling with on many a transaction or structuring of an investment. Briefly, I've been involved in carbon markets for a very long time, and it's frankly it's a real pleasure that the markets have picked up in the last few years around the operationalization of the Paris Agreement and the general influx of new investors into the sector. So it's fantastic to be able to deploy all the knowledge that we've been building over the last, well, really decades at Baker McKenzie to new investments and new clients. But Ruth.
Thank you. Thank you, everyone, for joining us today. And thank you for all of your support in relation to the topic that we've put forward. We very much appreciate that. Like Andrew, I've been working in this space now, goodness, for 20 years, and this has been one of the most exciting years for us with all the work that's emerging in the carbon market space and internationally off the back of Article 6. So as Andrew said, we're very pleased to be running through this topic with you all today.
If we just move on. So today, what we really wanted to cover, Ruth and I were talking about this back when we were planning it, is recognizing that there's a lot coming and there's a lot happening. And there's a lot of new people into the market, there's a lot of experienced people in the market, but wanting to grapple with the idea that things are not how they have been before. How is the introduction of the Paris Agreement and the implementation of emerging market laws likely to change how we've done things before and how it could impact on future projects? And to sort of do that by actually looking at some countries. So we're going to be talking about some high-level themes today, but the conclusions we'll share are based on the analysis of climate laws introduced by 4 different countries in the last really 9 to 12 months. So Ruth's going to take us off by sort of giving us a bit more context about why this is important and how it all fits together. I'll then talk about some of the conclusions coming from the analysis we've done for today. And then we'll both be sort of grappling with, well, what does it all mean for markets and for investors? And then we'd like to sort of move to Q&A. If you just go to the next slide, thanks, Sylvia. Just on that, around Q&A and housekeeping, we are recording the session today, so others can enjoy the benefit of some of this work we've been doing. We are, though, Ruth and I, both keen to have a conversation or to respond to your queries and your interests, etc. So there is a Q&A function. Appreciate you won't be able to speak live, but please put your questions in. We will tackle them at the end of the session, or if it's relevant, we'll pick it up then. And yes, people still do this stuff from home. We are still in a COVID world, so if there are any background noises, please excuse us. Great, let's kick off, and I'll hand off to Ruth.
Thank you. All right, so this first section, we just wanted to run through first principles under the Paris Agreement, which will be familiar to many in this audience, but worth just reflecting on where we are at this junction in time and why it's important. And so this first slide, we just wanted to take you through the role of nationally determined contributions under the Paris Agreement. So if we just take a step back in time, you have the United Nations Framework Convention on Climate Change and the Kyoto Protocol, and both were shaped by differentiation. The differentiation that is between developed and developing countries. And then the Paris Agreement was unique in that it broke this legacy division, and it required all parties to submit a nationally determined contribution. And it set a framework around that as well. And so developed countries should have an absolute economy-wide targets, and developing countries should move over time towards economy-wide reductions or limitation targets. And the other interesting thing that came out of all of this is a concept of a top-down, bottom-up approach. So there's a top-down goal in the Paris Agreement of well below 2 degrees Celsius, which will be familiar to so many people here, and to pursue efforts to limit temperature rise to 1.5 degrees above pre-industrial levels. And then the bottom-up concept is that parties must submit their NDCs and then update those over time. So here we've just wanted to run through ambition, transparency, and enforcement of NDCs. So as each party is self-determining their NDC, but the framework within which they have to do that is to reflect the highest possible ambition. And NDCs must be revised every 5 years with a view to enhancing its level of ambition. And this was designed to minimise the risk that countries fail to make sufficient domestic policy reform to achieve the global emissions reduction target. Now, there's this concept that's been introduced, global stock taking, which has a new acronym of GST, which is rather unfortunate for us in Australia, which is our national goods and services tax as well. But anyway, there's GST here at an international level on progress towards the well below 2 degrees goal every 5 years from 2023. So some of the work on that global stock taking has already commenced, but we'll see the outcome of that work next year. There's also the establishment of a transparency framework, which is established to allow the parties to track their progress towards the well below 2 degree target. Now, this is international law, so obviously it's facilitative, it's a non-punitive framework. The other aspect on transparency is that NDCs are publicly available, enabling society to hold country governments accountable for their pledges. In Australia, for instance, we had a change in government in June, and part of the change was campaigned on higher ambition on NDCs. And if you're in the Australian audience here with me tonight or today, I can report that the Australian government uploaded their new NDC back on the 16th of June. And so those things are very easy to access if you're interested. Now, under the Paris Agreement, there's also a compliance committee that's been established to facilitate progress towards the global goal. Interface with Paris Agreement mechanisms. So Article 6 enables parties to voluntarily cooperate to implement their NDCs and pursue higher ambition through the use of what are now called internationally transferred mitigation outcomes under Article 6.2. So this is a cooperative framework. So 2 countries can agree on what they consider to be mitigation outcomes within the Article 6 requirements and enter into an agreement for the transfer of those ITMOs. And many people will be aware that Switzerland, for instance, has entered into a number of these agreements, and they're available publicly available on its website, including agreements with Peru and with Ghana, and other countries are obviously doing some very active work in this space as well. There's a new mechanism under Article 6.4. Many have dubbed it the Sustainable Development Mechanism. Now, this is a mechanism that will essentially build upon the work that was done under the Clean Development Mechanism under the Kyoto Protocol. That mechanism is being phased out and is being replaced by the Sustainable Development Mechanism. And then there's a framework for non-market approaches under Article 6.8. So the name is intuitive as to what that means. So it's approaches that aren't market-based, things like capacity building and other cooperative approaches between countries. Then COP26, the COP26 finalisation of the Article 6 rulebook is an important development, particularly because it required a consistent approach in respect of corresponding adjustments. Now that's an accounting mechanism to ensure that there isn't double counting on emission reduction units. There was also an important recognition that host countries may authorise ITMOs for use for other international mitigation purposes. So what that means is ITMOs can be used first and foremost for a nationally determined contribution, but parties working together also have the flexibility to determine whether they will authorise ITMOs for another purpose, being another international mitigation purpose. And because this is cooperative, there's flexibility for the parties to determine what that is. So there is the scope for it to include units on the voluntary carbon market and potentially incorporation on CORSIA and things like that. And we're very happy to talk about that in more detail. So the key takeaways on where we're at with developments under Article 6 is a slow but steady operation of the Paris Agreement, which places pressure on all parties to tackle NDC implementation. Developing countries are moving to do so, and this will impact on the voluntary market projects that we've seen to date. Some of the key questions are, how will emission reduction projects support domestic targets? And this is quite interesting because, you know, to date, the voluntary carbon market has operated essentially on its own without necessarily having anything to do with the domestic targets of a host country. But we're seeing a change in that regard as a result of what's happened under Article 6, and Andrew will speak to that shortly in a bit more detail. Another one of the interesting questions that has come out of all the work that we've spoken about today is, will the export of emissions reductions be via an Article 6 mechanism, or will it remain under voluntary carbon markets, or probably a combination of both options remaining in the market? And so these are some of the things that we're experiencing here at Baker McKenzie, and it's interesting to see how the market is emerging in this regard.
Great, thanks, Ruth, for setting us up. So I guess the high level or theoretical approach in the Paris Agreement is what we've all been working towards, and frankly, it's taken a lot longer to get to the Paris Agreement and the implementation of that than any of us would have wanted. But it's very easy to sort of focus on the Paris Agreement and always be worried about the next COP, etc. But the real question is, how are we actually going to do it? So how these NDCs that we've now, from a bottom-up approach, developed, and particularly in emerging markets as those NDCs are crafted, how are they actually going to be implemented? What does it actually mean on the ground in these countries? And there's been a lot of work on that already. There's a lot of studies out there, but we sort of picked the fact that we saw over the last, in the build up to last year's COP, but then earlier this year as well, some sort of an increasing number of examples of climate change laws being introduced, which are clearly around creating the tools by which countries will implement their NDCs and do deal with things like domestic emission reductions, export of emission reductions, etc. So trying to work out how to sort of tackle that and sort of break it down for analysis, we picked three themes, and those are broadly, how do these laws approach domestic emissions, so the key emitting sectors? What's the role for domestic emission reduction projects, whether avoided emissions or sequestration? And finally, do these laws specifically deal with how this fits with foreign exports of achieved emission reductions, whether through Article 6 voluntary markets or otherwise? And as you can see here, the countries we picked were Indonesia. Indonesia brought in presidential regulation late last year. There's a draft set of regulations which are not public, but which are sort of working through the Indonesian processes. Vietnam laws came in again late last year, and Brazil had a recent decree, and Vietnam was earlier this year, Gabon was late last year, and Brazil's decree, which is very high level, so there's limited analysis we can do on that, is relatively recent, only a few months back. So we just go to the next slide. What we, recognizing we don't really have the time to sort of drill into all of the detail, and we've got quite a lot of detail in some tables at the back of this session, which will be available to all of you who've participated in when we send it around. But sort of the themes on theme one, that the broad conclusions that sort of come out is clearly that the focus of these laws are on a core set of key emitting sectors, which is usually thermal energy generation, waste, industrial processes, and then slightly differential, but often forestry and agriculture, not in all. Quite importantly, almost all look like they're moving to what we would call a cap and trade approach. So setting a target for a sector that is aligned with the NDC for that country, and then imposing sort of a limit or a cap or a quota is most often used, a quota of emissions that an entity within that sector is allowed to emit over a period, whether that's a compliance period of 1 year or 5 years. And then if they don't bring their emissions below that, or use tools, which we talked to, such as domestic emission reduction credits, or using credits from those that have beat their quota, they will face penalties, which is all broadly consistent with what we all understand, and which the World Bank's through its program of market readiness has been trying to train countries in for many years. But I think it's quite interesting that has been taken by almost all of these countries that we've looked at it in the recent laws. In terms of implementation, variable, some are moving quickly, some are moving slow, but it's all tied to sort of thinking about NDC and building towards often pilot phases through to 25 or 27, something like that. But trying to drive towards real implementation in the second half of this decade, aligned with the broad block approach that the NDCs have under the Paris Agreement. I'll come back to views on whether people will hit those kind of ambitious timelines for implementation, but let's move on to the next slide. So what role for domestic reductions? Broadly speaking, all the laws are looking at enabling domestic emission reduction projects, setting out authorization procedures by which those will be authorized and enabled to produce offset credits within country, and for those to be used by covered sectors. So if you're in the Indonesian thermal energy sector, you would be able to use Indonesian offsets to meet your upper limit on emissions if you've gone over your limit. Broadly speaking, they do generally align with what we see as a sort of the usual skeleton of a sensible and workable approach to developing reliable offset credits. So the idea of, a validation process, verification process, issuance, the use of independent entities for different steps in that chain for reports, referring to relevant ISO standards, etc. A lot of the laws do have that. But the quite interesting thing, particularly for so many of us who have always worked in the voluntary market, where this is a very known process, but it's a known process you're working through with the verified carbon standard or with the gold standard, is that the push for this to follow those kind of approaches, but to have it within country, so that there'll be new agencies or new ministries that will be needing to sign off on these steps, which provides an interesting dynamic, even where some of these laws refer to possibly being able to still use, say, a VCS process, but you would then have to funnel sort of reports, etc., through a local process to get sign off. Some of the laws do recognize the possibility of minimum prices for domestic offsets to kind of, I guess, support a domestic offset industry, but also aligning with, that will need to align with the expectations of those covered sectors and the lobbying that will be pushing back and forth on that. And quite regular reference to levies on transactions to do with domestic emission reduction transfers, or as say in the Gabon case, is sort of a share that is taken by government for government to trade in its own right, or Indonesia, where it's a sort of a split between it's not clear if it's a share or a levy, but a 10% sort of a profit share, if you will, that may happen. But also then, interestingly, with Indonesia, a possibility of a 10 to 20% cut on achieved reductions, which will just not be issued and notionally held just to create a buffer for the wider NDC achievement. So that there's kind of a growing sort of achievement that's being held within the system rather than being distributed and used by participants. We just move on to the next slide. So particularly for those attending or listening on the recording that are involved in the voluntary market already, or looking to be involved in that market, this is probably the most critical theme. How does business as usual change for the voluntary market? Will say, for example, a VCS validated project in a country still be able to successfully achieve reductions and have those issued offshore under another system, but will that still continue? That's probably, unfortunately, that's the one that's probably hardest to give a very clear answer on, because in some cases it's not entirely clear countries themselves have got the right answer yet. But at a minimum, you can say that there is likely or will be new authorization procedures. So even in countries, say, such as Indonesia, where there is existing paths by which people have achieved a government authorization that enables them to create emission reductions or sequestration for the purposes of say, a VCS project, there is going to be a new approval process and a new type of authorization. But again, sticking to Indonesia as a good example, there's a clear focus, if you will, or theme that's occurring where there is a real engagement with the idea that if we are having a domestic emission reduction offset system and we are having covered sectors, should we not ensure that the achievement of those emission reductions are used or available to domestic covered sectors first, before enabling the authorization of effectively foreign export of achieved reductions? That is the million-dollar question. You could say how that will play out. Even if you look at Indonesia, where that's a real live question, it's not clear entirely on their draft regulations on how they really will tease that out. At what point is something achieved sufficiently within country against targets to then move to enabling foreign export, or could they happen in parallel with each other? I think the jury's out on some of those really tricky and granular points. The other element here is, if you recall Ruth's intro work mentioning that, you know, a country can authorize for the purposes of Article 6 transfers that will have corresponding adjustments, but are for other mitigation purposes. Doesn't necessarily have to be for another country's NDC. That's an interesting dynamic or tool that might be used by a country to enable effectively a voluntary market plus, where voluntary type credits could be issued with a corresponding adjustment, and that could be seen as a positive for the country due to value, the tax that would apply, what have you, as well as being of interest to foreign buyers and users. But then when you look at some of these laws, when they talk about sort of how their own registries and offsets will interface in an international level, I guess we would say that it seems that almost all the assumption in the language or the laws is really more about Article 6 per se in the terms of Article 6.2 or Article 6.4. There's a little bit sort of too narrow a focus, you could say, on that. And perhaps that's a lack of sophistication on some of the parties drafting these laws to date. We just move on. So just to recap, and many of these I've touched on already, so I'll be quick. But you know, obviously countries aren't getting real about this, and I appreciate that it's a highly volatile world environment. You know, fossil fuels on the rise in the light of some of the crises, etc. But alongside that, there are many countries that are taking these obligations on the Paris Agreement very seriously and are looking at this as an implementation challenge, but also as a way of saying, this is the path by which we will help these sectors modernize and become fit and ready to be part of the advantages that will come out of a future green economy. In terms of what it will mean for voluntary projects, there will be new approval processes. On the implementation process generally, yes, I think we would think that even having gone through it and say the EU or America or Australia or whatever, that you know, saying we're going to have an emissions cap and trade system or we're going to have a quota system is in some respects more easily said than done, and that there are usually a lot of teething issues and deep sort of lobbying and industry tensions that come through the actual implementation of that. Even if you look at, say, the China pilot schemes, I think most of my career I've been hearing about Chinese pilot trading systems, but you know, they got there in the end, but things often will take longer than anyone expects. And the question is what sort of uncertainty that might create if you do want to engage with a new system for, say, a voluntary sector project that's going to be reauthorized. It's important to know, well, will that national registry be available? Is there actually going to be a ministerial team that's ready to authorize me? So these can become quite important questions. And then, yes, as I said, the engagement with how this will work on a foreign export level is still somewhat unclear. Ruth, if I just hand off to you for the next slide, perhaps.
Thanks, Andrew. And yeah, I agree with you. This question around export of credits from a host country and whether they have host country authorization and whether they can, whether, say, a voluntary carbon project can just continue as before without any barriers to export, or what those barriers will be, is something that we're starting to see emerge from as on a case-by-case basis as we look through each of these jurisdictions. So if we could just talk about this in the context of market impacts. So in the projects that Andrew and I are working on at the moment, you know, they're all founded on various contracts, and the impacts of what we're seeing now in the market is that force majeure and change in law provisions, we think, will become even more relevant for existing projects. And so it's one thing when you're going through your contracting to check, you know, the breadth and the robustness of those clauses. And, you know, if you do end up in a situation where new laws emerge that may have implications for a project, to what extent those clauses can assist during that process. On this question of exporting and permissibility, country policy due diligence is going to be critical for new long-term deals. And so, like I said, this is going to have to be on a country by country basis. And it's a legal due diligence on what the applicable laws and policies are from a climate change perspective, and just with the establishment of various bodies that we will start to see, you know, climate change bodies with authorization powers, what their systems and processes are going to be. Because one thing Andrew touched on is there's some really interesting laws that are emerging in the jurisdictions in Asia and Africa, but we're yet to get to that point of all of the implementation of those laws. And so there will be a series of further systems and processes that will come off the back of those laws and regulations that we'll see over time. Another major market impact to be thinking about is ensuring strong buy-side rights regarding managing changes in law. That's going to continue to be important. And near-term policy changes may lead to medium-term policy certainty and deal upsides. So I think we're going to continue to see so many projects in this space and increase in projects in this space, just as we're going to see these changes in the market come to fruition. And, you know, as the changes emerge and become more certain, that will obviously provide further certainty for future projects as well. And then the role for investors and stakeholders to explain the benefits of continued voluntary market investments. So I think particularly when dealing with these projects in emerging markets, there's a real opportunity for dialogue with the authorities about you know, what the authorities want to see in terms of NDCs, meeting the NDCs, and you know, whether there will be a percentage that goes towards that, like the Gabon example or the Indonesian, but also what the countries want to see in terms of bringing investment into these projects in the particular jurisdictions. And we see the potential for there to continue to be strong benefits in having the voluntary carbon projects in these markets, together with projects that fall under the Article 6 framework. And I think that's, you know, having those dialogues and forming those relationships are going to be a very important part of the process. So I think, Andrew,
I'd agree, Ruth, that it seems to us that sometimes people seem to be rushing to think that the voluntary market is not necessary anymore because we've got this big shiny Article 6. But Article 6 is not going to be ready immediately. Article 6.2 country-to-country deals take time and then need to be operationalized. So there seems to us to be a fundamentally important role for the voluntary sector and the money it can bring to bear and the experience it brings to bear to continue to be deployed, at least in some sort of parallel transition manner in which, you know, as Ruth said, whether they're side by side or transitioning over time. And this is my sort of personal bugbear as well, as if I was in charge of a country's NDC implementation, I would sort of be looking at what I want to achieve in transport, or what I want to achieve in agriculture, or different sectors that are important to me as a country, and then saying, I've got this entirely amazing pool of capital that's ready to invest. Why don't I work with the voluntary sector, but maybe put some guide rails on that to sort of say, look, I want you investing in these types of projects within these sectors, because that's what's going to help my country develop. And that's what's going to underpin the whole point of what all this was about, which is technology transfer, cooperation, achieving shared goals. Yeah, but yeah.
Oh, I was going to say, no, I think that's a really interesting point, because a lot of this has been driven on a voluntary basis in terms of the projects that are generated and where the investments are going. And now, because of what's happened under the Article 6 framework, there's this real new opportunity for countries as well to be saying what they would like to see in terms of level of investment in their country. And I would hope, like you said, that sees even more types of projects being generated in this space. So it's quite an exciting time, really, when you think about it from a transition perspective.
Great. Our plan was to be aware of time and possible questions at this point, because we're sort of in the back end of the presentation, but maybe we've bamboozled the audience, or there was a shy audience, but we haven't got any questions yet. So please, we'll keep talking, but shout out, and we will definitely look to engage with any Q&A. And while that's coming in, I guess just to return to that point around near-term policy uncertainty versus long-term policy certainty, I think that is interesting, because it is easy when there is change coming at a domestic level to see that as a wholly a negative outcome. Okay, oh, I knew how to do a VCS project in country X. Now what am I going to do? There's a whole new authorization process coming, or what's going to happen. But let's remember that maybe the market will move, and I'm not pushing this one way or another, but maybe the market will work where there is a higher value for voluntary credits with corresponding adjustments. So getting through the sort of the valley of uncertainty to a legislative model in a country which allows you to have an authorized project capable of generating credits with corresponding adjustments that are available for transfer could be, you know, a pretty valuable outcome for any project. So I think it's always important to remember that yes, we have to get through the next phase of implementation at country level, and that may be difficult, but the outcomes might be quite valuable for investors and ultimate, you know, end users of voluntary credits, for example.
So Andrew, we've got a great question here, which I'm putting you on the spot, but I think you're in a good position to answer this one. So would you like me to read out the question?
Okay.
Yeah. So it's a lovely thank you from a member of our audience for the presentation. And they've asked, you know, if this is a new area, where would one start in terms of research and information and resources? I can maybe get the ball rolling. How about I get the ball rolling, and then you can add, because I've had the benefit of seeing the question. But actually, there was a really interesting paper that's just come out by the World Bank, which is sort of a state of play on the voluntary carbon markets and how much level of investment is being made at the moment and where it needs to be. So I'll put out a little recommendation on that. There's so many resources available, even just on UNFCCC website to do with Article 6. But maybe what we do when we circulate the pack, we can just put a couple of little dot points of some of the good go-to publicly available sources.
Yeah, I think there's a couple of good papers out there on status of NDC implementation as well that came out pre-COP last year. There's another good question here, which I love this question because I have views on this one. What are your expectations with regards to linking between compliance markets and voluntary credits? I can answer that. Yeah,
you go first. Yeah, it's a great question.
Two parts, and I'll use a European perspective because I live and work with the EU ETS and the UK ETS. Generally, voluntary credits in the old sense of the word, so without corresponding adjustments, not on Article 6, just pure voluntary credits, those are not going to be accepted within the EU anytime soon. The policy dynamic, if we go back in time very briefly, what made the clean development mechanism explode as an investment and as a sector that led to a lot of investment in countries was Europe saying that CERs, so the certified emission reductions under the CDM, could be used for compliance purposes in Europe. So suddenly you were attaching a compliance market-driven price point to emerging market emission reduction projects. And that, I think, is the dynamic that is really relevant to this question, is at what point will a significant compliance market like the EU ETS say that it is prepared to accept Article 6, ITMOs or credits with corresponding adjustments, or credits coming out of the 6.4 mechanism. Because fundamentally, I would say that if we deliver Article 6.4 in the manner in which it's intended, which is, additionality, robustness, high ambition, etc., then it should have addressed many of the concerns Europe had around the CDM. That said, generally also add that Europe seems to be very focused on Europe these days. So that if it talks about offsets or if it talks about reduction opportunities, it wants that to be focused on Europe to change Europe's industrial behaviors, etc., which is done a slight difference to the past. We are on time, and we do like to stick to time. There is a couple of questions we haven't got to. We will quite happily come back directly on those questions. And this webinar is just one of a series of webinars that we always are doing in the build up to COP or generally. It's all available on our hub that you can access. And we will be on the ground in Egypt, as we have been on the ground for decades at COPs. So as we move forward to that, we will be continuing to be in touch on topical areas. And with that, Ruth, any final words to send our audience off?
Oh, thank you. I would like to say thank you to everyone, and thank you so much for the questions. I think, as Andrew said, we're going to be having more of these sessions in the lead up to COP. So we might even recalibrate how we format this for the next one, so that we get even a little bit more time for these questions, because the questions are fabulous, and we find that for us one of the best parts of being able to have these webinars. So thank you for reaching out to us, and thank you very much for your time today, everyone, and thank you, Andrew.
Sorry, so I didn't mean to have the last word, but one thing I forgot to say is, because we're focused on the front end, the back ends of these slides, which will be shared with you, include snapshot tables summarizing each of the countries, so Vietnam, Indonesia, Gabon, and Brazil's actual detailed approach to some of the nuanced points around emissions quotas, domestic emission offsets, and foreign export capability. But thank you very much.
And I guess, and the only thing would be, if people want to continue the conversation, they can always reach out to you and I, right, Andrew? That our email addresses are up there, and so I think there's many conversations to be had on these themes, and with our details there, you know where to find us.
Thank you.
Thank you.